Friends, I, Captain Vivek Jain, welcome you all to this 8th episode of mine. Having identified the industry and selected the business we choose to be in, and then having purchased the equity shares, we now have to exercise patience. Lots and lots of patience. In fact, I will not be wrong in stating that patience is a compulsory virtue in stock market. Sadly and regretfully, in reality, it is actually the most neglected and rare. So friends, our today's subject of discussion shall be precisely that. In order to exercise and nurture the virtue of patience, we have to follow certain guidelines and methodology. And I will try to apprise you with that. Friends, we'll start our discussion. And as I said, the virtue of patience is the most compulsory requisite in the stock market. Many of you who may have bought and sold equity shares so far must have experienced a strange and common but a true phenomenon. We buy a share at a given price, which we think is less, and then lo and behold, it starts falling. We sell a share at some price we think probably is at the top, and then to our surprise, it continues to rise. In this regard, friends, let me tell you a very famous quote. The funny thing about stock market is that every time a person buys and another sells, both think they are astute. To a large extent, this happens due to lack of patience, and to some extent, we don't feel happy that others have gained more than us, or we could have gained more. When you buy a share, you must bear in mind a certain lower figure which is tolerable by you. Hold the scrip till that tolerable level. Maybe the scrip will stop falling well before the lower tolerable figure which has been put by you, and then it resumes its upward march. That tolerable lower figure, friends, is well known as stop loss. Stop loss is very much necessary in the market. If this stop loss figure is pierced, you may consider selling and booking loss. But do remember this term called stop loss, friends, because this is what probably will be added as a safety measure in your trades and investment in the market. It is not only extremely important, but extremely popular. It will be mentioned frequently in our discussions henceforth. It is the most talked about term in the stock market, friends. Stop loss. It is a theory, in fact, which must be followed for inculcating discipline in our mindset. A positive motive is to attach safety to our capital investment. So this is something which you cannot ignore. When you sell a share and it continues to rise, I don't think you should repent. After all, let the new buyer also earn. You can very well keep an eye upon the scrip so that if it does starts falling again and it pierces your sell value and comes below that, maybe you can consider it for repurchase. However, when you did sell, you must have gained, I presume, and that profit must have been your objective. So why repent when you did attain your objective? Now the question arises, what and how much should the objective be when my share rises and appreciates? When should I sell? This is a $1,000,000 question. Friends, to a large extent, this will depend on everyone's own patience, stamina, appetite. However, I will offer some advice here, some guidelines here, which every individual can probably adopt it in his own way. The length of holding scripts is something which is different all over the globe by every individual. And this is where my suggestion is that we can divide the objective of selling and profiting from equity shares into three different groups, three segments. First is short term, second is medium term, and the third one is long term. I will definitely try and explain each one of them to you herein. Please hang on. Let's take short term first. Short term would mean I am basically trading in equity shares of a well-selected company, the company of my business which I've chosen, and I would like to book profits by floating and rotating funds. The fund which I've earmarked for short-term trading, the fund which I wish to rotate by buying and selling so that I can continually make profits. And I will retain the share if it does not pierce my stop loss level. Till such happening, I will keep the share. And during the short-term period, if my objective is reached, I will sell. If it is not reached, I will review whether to hold it during the short term, convert it for a longer period of holding, or sell it at less than objective. That will depend on the circumstances, friends. Now, what is the short-term period? How much? How many days? How many weeks? I can put a suggestion over here. Assign a range between 2 days to 6 months, something like that. And the booking profit level, what percentage from my purchase price shall I attach and keep my objective? My suggestion is 10% net, at least, or more. This is, of course, after excluding the brokerage cost, both ways, a brokerage for buying and brokerage for selling also. The net should come in your kitty is 10% and above. Now let's take the next one, medium term. This means I'm investing in equity shares of a good chosen company of my choice, the business of my choice. It may give profit after a little while. But I'm not very keen to continue staying in the business for a long time due to many reasons. And here I would like to stipulate a period of holding of between 6 months to 2 years. That would probably tantamount to holding it in medium term. Booking profit level, over here I would say 25% net of brokerages. Buying and selling, the difference after deducting the brokerages should come in your kitty at least 25%. During the medium term, if it doesn't touch your stop loss level, you keep it, you don't book loss. And if it reaches your objective anytime, you sell it. And if it doesn't reach your objective at the end of the medium term, you review it, whether I should keep it for a longer period of time or whether I should sell at a less objective, lesser than 25%. Again, it will all depend on the circumstances. Finally, we come to long term. This would mean I am investing in the choicest shares of well-selected businesses. Businesses, because I'm sure that you probably will buy shares of more than one company. As we say, don't put all your eggs in one basket. And I would like to hold them for a period ranging from 2 years till as long as I wish. There is no upper limit to long-term, friends. It cannot be defined here. It will again depend on every individual, in the needs of every individual, in the mindset of every individual. And believe me, friends, I can tell you with experience, this segment of long term will not only reward you the most, but it may surprise you immensely. Several and most of the blue chips of today, when they were held for long term, they have turned genuine, patient investors into millionaires. You may check online with data available for shares older than 5 years, the prices before 5 years, and you can check and you can see how well they have appreciated. And there may be some friends and your acquaintances who may have kept some of those blue chip shares for more than 5 years. You can ask them what capital appreciation and dividends in between it has given. I will, of course, give you some concrete examples in due course of time. Right now, I am only in principle trying to explain these three segments. There is a very interesting episode, friends. Allow me to relate a very interesting conversation. One of my friends, whom I revere, not my friends, my guru, you can say, a stock market doyen, Warren Buffett, who was asked a question by a stock market enthusiast. Warren Buffett, let me introduce you very briefly, although I'm sure all of you must be knowing him. He's an American investor, business tycoon, and philanthropist. He's the chairman and CEO of Berkshire Hathaway, which is a huge financial company in the United States of America. Today, he's about 89 years of age, and he's considered one of the most successful investors in the world. His net worth is around $72 billion as of in July 2020. That makes him the fourth wealthiest person in the world. The query that this person, the stock market enthusiast, put forth to Warren Buffett, the great, the investor asked him, "Sir, how do you decide when to sell a share?" You'll be surprised with the answer. The reply was, "I never sell a share." There are many reasons to it. There are many theories to it. You don't have to go exactly verbatim, but in due course of time, I'm sure you will understand the depth of this answer. Friends, I would now come back to my stop loss theory, and I will briefly explain that to you. When any of your holding script rises, maybe you have kept it in short term or medium term or long term, you simultaneously keep attaching a stop loss figure as the script value is rising. This is called trailing stop loss. I will explain you with a little example over here. Stock price rises with intermittent falls. That means whenever a price of any script rises, it will not go in a unidirection or one direction. It will in between again drop, take a breather, and then resume its march upwards. This is inherent cycle of the stock market, and this is because of profit booking by various people who are there in the market along with you and me, and technical correction, as it is termed as. Although it may not be practical to attain the peak value of sell, because no one can really predict where this script will actually peak out. But trailing stop loss will allow you to exit somewhere near it. A dynamic stop loss setting in a rising script if it is triggered at any level, it will not give you actual loss. Now, the example that I assured and promised you is here. Let's take an example where you purchased a share for rupees 100 and the stop loss you have attached 90 rupees at 10 rupees below. The share price is rising. It comes to 110. You have raised your stop loss to 100. Share price rises further, goes to 120, and your stop loss also trails and goes up to 110. Now let's say the share price is falling from here. It may fall to 118, 117, 115, 114, 112, not reached 110 as yet, so you will still keep it. And from 112 again, it resumes its upward march and reaches 130 this time. The stop loss is also trailing and has been revised to 120. Now, at any point of time after reaching 130, let's say for example it starts falling and this time it reaches 120. As your stop loss was at 120, probably you will sell it. It is called stop loss triggered and you sold the share. The share that you purchased for 100 rupees, you kept an initial stop loss of 90 rupees, but you sold it at 120, which is a profit of 20 rupees. There is no loss that you incurred, only because of the trailing stop loss. Of course, the only disadvantage, probably notional disadvantage, is that you were unable to sell the share at 130, the peak price, because maybe after 120 stop loss getting triggered, it may again resume its march and go above 130. But then the safety factor we have to keep in mind, the discipline that we spoke about, we have to keep in mind. We cannot take it for granted. It may pierce 120 and go to 110. So the stop loss that we assign should be strictly more or less adhered to. That is what I'm trying to explain, friends. Friends, to conclude our discussion so far, I think I have been able to convince you of the objectives of equity shares investment. I have described the three segments of holding. I have explained the theory of stop loss. Now, the ability of choosing good businesses and sound companies need to be discussed in good detail. And that we shall indeed embark upon in our future episodes. Friends, I would like to remind you that if you have found this discussion knowledgeable, interesting, do subscribe to this channel in case you have not so far, so that you can get the past episodes and the future ones in good time. Put in your queries and your comments in the space provided. I will definitely try and reply to all of them. See you again soon, friends. Have a nice day and happy investing.